Coming up today, stocks continue to rally as Oracle rips higher, another hot IPO, bearishness hits lows, the dollar slumps the worst in decades, what message is gold and oil sending us, and could we be on the cusp of a black swan event? You don't want to miss this one, guys. Let's go. And it was another soft day of trading on Wall Street. Market's still coiling up on really low realized volatility here. A little bit of a defensive feel today in staples, utilities, and healthcare, bumping up. Whilst it was a bit mixed, looking at mega cap tech there. Helped out by great earnings and forward guidance from Oracle, which I'll get into in a minute. And so for here at least, it looks like the melt up continues. S&P 500, 60.45, now just a little over 100 points away from all-time highs at 61.48. As the market seems to be drifting here, that is until we get a new catalyst, which could be just around the corner. As I'm about to show you, the tail risks of a black swan event potentially happening this weekend have gone up. I'll get into all the details of that along with the odds from the prediction markets and what the chances are that may occur, as it doesn't appear the stock market is keen off tariff-related headline anymore. They don't seem to be moving the markets much. And now we're coiling up just below all-time highs in what has been a really resilient market this year. In fact, the second best year when it comes to the returns from buying the dip. Some are likening it to the Rocky Balboa market, always getting back up. S&P 500's average return after a down day, 0.29%, only eclipsed by 2020 when we had a huge recovery. And we are deep into an eerily period of calm. And in fact, this chart's a day old. We've now gone 11 sessions without a 0.6% swing in the S&P 500. The market is coiling up on really low volatility, even though we've been getting a little bump up in the VIX the last 2 days. The price of options has gone up a little. And what helped prop the market up today was a bumper result from tech heavyweight Oracle, beating slightly on expectations and also bumping up their forward revenue guidance, helping to send shares up over 13% today, brand new all-time highs. That coupled with the Nvidia CEO from Paris saying this is going to be the decade of autonomous vehicles, robotics, and machine, with Nvidia shares also just sitting below all-time highs there, coming off their great earnings result 2 weeks ago. And we've also got the market for new equity heating up, IPOs. We just saw Voyager yesterday, Chime Financial today, banking services app, like a lot of fintechs experiencing huge growth. Stock did really well on its first day, up nearly 50% from their IPO price of $27. Current market cap around $15 billion. Similar story from Voyager Financial yesterday. And there's still a bunch of hot unicorns out there, as they call them, billion-dollar plus private companies that haven't come to the market yet. They very well could this year and over the next year or two. Some of the most sought after: SpaceX, Anduril, which I profiled yesterday, Databricks, Anthropic, Stripe, Klarna, OpenAI, XAI, amongst a bunch of others. The pipeline for hot IPO is strong, and no doubt the investor demand and premium valuations are there. It is a great time for these companies to come to market with S&P at all-time highs. And investors are feeling good again as we went from persistent bearishness, now getting persistent bullishness. The fear and greed index now been in the greed zone for over a month. And now bearishness amongst individual investors has hit the lowest level since January. And we can see that in the latest AAII investor sentiment survey, getting down to 33% bearish reading. First time we've seen that in months. And that optimism is also showing up in the options market. There's a lot of put hate out there. Traders aren't buying put options. Instead, they've been piling into calls. Looking at the latest put-call ratio, 0.57. It's definitely down near the low end of the range, something we can often see at short-term tops in the market. And it's not all that unusual at this time of year. Just looking at seasonality in the VIX index, basically a visualization of the average implied volatility of 30-day at-the-money options in the market. And so here we are now in the middle of June, getting towards the end of Q2. And quite often, this can be a time where we see the lows for the year in the price of volatility. Same with going into July. Quite often we'll see volatility rise in Q3 going into Q4. Looking at the average VIX pattern, going back to 1990 in the dark grey here. And even when you strip out those volatile years of 2008 and 2020, when we had market panics, the VIX still follows a similar path. And especially so last year, when we had that massive VIX spike to 65 back in August. And with the VIX recently been at multi-month lows on a 16 handle, I've been taking advantage of that and putting on custom VIX index options trades, which I've been sharing with my members, to not only hedge my other short premium positions, but also potentially profit from any surprise spikes that may be just around the corner. And there's a look at the VIX today, just expanding this chart. We actually made it above 18.5, almost reaching 19. Still below the 200-day moving average at 19.6. And actually just looking at the volatility heat map, you'll see how quiet it's been for pretty much 2 months now. And if I zoom out, you'll see the longer we go into contraction, the more likely expansion is just around the corner. And my reversal signals indicator do a great job at letting us know when it may be a good time to throw on some hedges, which I did on Tuesday when we got that one there. And bumping up even more is the implied volatility on VIX option, which can often lead the VIX in the market. And we're certainly getting a bit of a bump up in the oil VIX OVX these last 2 days. And I'll get more into that in a minute. And so we had quite the growth scare coming into Q2 with Liberation Day, quickly building a consensus that we were going into a recession. In fact, Goldman Sachs odds went from 15% to 45%. And like the rest of the street, they've dialed them down a bit since then. Still sitting around 30-40%. They think we get a recession at some point in the next 12 months. Nowhere near the odds we had back in mid-23. Most people were convinced we're on the cusp of a recession. But what hasn't bounced back as well is GDP forecasts, how fast the US economy is going to grow. The consensus is still somewhere in the low ones. And that coupled with stock valuations at the top end of historical ranges has no doubt got many investors questioning how much equity exposure in the States at least should they have, or should they be adding any hedges? And any investors that were worried about the next 6 to 12 months, now wouldn't be a bad time to buy some insurance with the VIX at 17. Ideally, you want to buy it when no one else wants it, when you can, not when you have to. And is it those same valuations that are causing a number of corporate insiders to sell their shares, with the insider ratio also at the bottom end of its multi-year range? And one theme in financial markets we've seen this year is a massive rotation into European equities. And that may have something to do with the fact that valuations in Europe, in their own absolute terms and relative to the States, some of the best they've ever been. Just looking at a chart here of total shareholder yield, and that combines dividends, buybacks, and stock issuance into a composite yield to represent total net shareholder return. And in Europe, that's currently near the top end of its long-term range as well, a bit above 4%. And I actually turned that concept of shareholder yield, which is like a modern-day version of dividend yield, into a custom indicator on TradingView. In fact, I'm the only one that's got it on the entire platform, shareholder yield, and that shows a percentage yield for every stock in the world. Currently looking at Alphabet Google, 3.18% shareholder yield, which is actually pretty good for a mega cap tech. And that rotation's been evidenced by a weak US dollar, slumping again today in one of the sharpest sell-offs we've seen in decades. And so the US dollar index is a basket which drives a composite against 6 other currencies, with the euro having the largest weighting, and that's been trading up against the dollar. We also just heard from the US president he's going to notify trading partners of unilateral tariffs in the next few weeks, ahead of the July 9 deadline of his 90-day pause. We're already approaching the end of that. And there's a look at the dollar index, trading pretty heavy there today, breaking down once again, and that's probably given tailwind to the price of gold, also trading firmly here today, keeping its uptrend intact, and that's likely the market also pricing in some geopolitical risk. Bit of a flight to safety as we head towards the weekend, just like we've seen in crude this week, sharply rising, now sitting just below $70 a barrel as Israel is considering military action against Iran, ratcheting up geopolitical tensions. And in fact, JP Morgan just came out and said an attack on Iran could spike oil prices to $120 a barrel, potentially driving US inflation to 5%. Quite a dramatic and bold call from Wall Street's biggest bank. And there's gold, just a few points below all-time highs, and doing better again today, the best performing sector, gold miners, look to be trading really firm at decade highs here. In fact, going out to the weekly chart, looks to my eye we could potentially be going into a melt up, and even more so on the monthly chart, we could already be in a melt up. And hence why I designed a specific trade using GDX options that seeks to take advantage of this. And I shared a screenshot of my trade fill with my members today in real time, which also serves as a hedge on anything happening in Iran over the next couple of weeks, which could potentially cause gold to skyrocket. And so it looks like communications between the States and Iran have broken down somewhat, in addition to a global watchdog finding Iran failing to meet its nuclear obligation as they continue with their pursuit of enriching uranium, for which the US president has warned a strike on Iran could very well happen if they can't come to a last-minute agreement, for which Iran's threatened back to strike US bases in the region if Israel may do anything to them. And just looking at prediction markets, currently about a 50-50 that will see Israel military action against Iran by the end of this month. And in fact, there's even a market now that we may see US military action against Iran by the end of this month. And that was actually above 30% in the last 24 hours, which is a little crazy to think. So at this stage, the odds weigh that we shouldn't see something soon, but there's definitely been a material increase this last 48 hours that we may see a military event in Iran. And that will no doubt spike oil, spike gold, and spike volatility in equity markets, for which my options portfolio is already positioned profit from, should that occur at some point over the next couple of weeks. But just moving on to the latest macro data, we got PPI inflation data coming in better than forecasts again. More good inflation news. Little sign of rising prices from tariffs. Maybe the fears aren't playing out. Maybe that big wave of inflation we had a couple of years ago was much more structurally caused than what tariffs can do. Maybe inflation's got more to do with the supply of currency rather than trade agreements with other countries. And maybe Jay Powell's going to be late again when he starts cutting. PPI only rose 0.1% in May, beating forecasts of 0.2%. We beat on year over year as well. And it actually looks like companies are somewhat eating the tariffs compared to raising prices. We can see that in this chart of CPI inflation, which is the change in prices, less PPI, which is the change in the prices of the inputs into goods. We can see that huge amount of inflation in 21-22, which caused pressure on corporate margins, and we're getting a little bit of that here again. And the labor market is vulnerable. Millions of consumers are still struggling with debt. Jay Powell wouldn't just be doing his president a solid, he'd also be doing his fellow countrymen a solid by cutting rates, allowing consumers to refinance and help out with the cost of living, because we could be seeing early crack in the labor market, with continuing claims for unemployment benefits hitting the highest since late 2021, and initial jobless claims also at the top end of their yearly range and arguably uptrending over the last 6 months. And that, along with a strong 30-year auction showing there's still investor appetite for treasuries, has probably brought yields down again here today. With the 2-year now at 391, the market's still a bit below Fed funds rate, doesn't appear to be pricing in any hot inflation for the here and now. And we can see that in the tip spread as well, come off a bit this week and largely being consolidating or a little bit lower this year. Along with interest rate traders increasing their odds by a little bit today, we'll see a cut in September, now looking at about a 3/4 chance. And the president once again lashing out at the Fed chair, calling him a numbskull for not lowering interest rates. And saying he's also going to pick a new Fed chair very soon. No doubt it's going to be someone ultra dovish. And that's one thing for the stock market to look forward to. We're very much likely going to get lower rates next year when Jay Powell's term expires, if he hasn't already cut them by then, which I don't think he wants to for some reason, as he's now speculating on inflation instead of being reactionary like he has done for the last 8 years. And so one of these men here could very well be the next Fed chair and person markets will closely follow in the coming years. And they're all likely to be bullish for the stock market. And moving on, in other news today, we've seen a bit of a pullback in Berkshire after Warren Buffett announced his retirement, stepping down at the end of this year to let Greg Abel take the reins. He will still remain chairman and plans to be in the office every day, just like he has done for the last 60 years, ever since he took over Berkshire Hathaway, a rundown textile company he transformed into his own personal, publicly listed hedge fund, if you will, which was a strong favorite amongst investors in Q1 going into Q2, significantly diverging from the market as they do have almost 30% of their entire portfolio in cash. That was really appealing to investors. But after their latest shareholder meeting and Warren Buffett stepping down, there appears to be a bit of selling, with the stock now just sitting above its 200-day moving average here in the grey line. Also in the spotlight today, meme traders' favorite GameStop hinting at its next Bitcoin buy, with quite a few smaller companies now trying to hop on the infinite money loop orchestrated by Strategy, formerly known as MicroStrategy, looking to issue debt and pile into crypto. And so they just came out today with another offering, along with their latest earnings results, which actually significantly beat expectations, but that debt offering seemed to overwhelm those good earnings. Market selling them off sharply, down 22%, potentially finding support here where it did shortly after the last earning. And this showed up near the top of the leaderboard for the most traded options in today's session, and I'm sure it will again tomorrow, along with AMC pulling back in sympathy with it. And just looking through my themes watch list, we saw robotics stocks come off somewhat today. A little bit of heat coming out of the hot categories. Nuclear had a bit of a pullback. Same with space stocks. Rocket Lab almost back to its 50-day VWAP. And AST Space Mobile looking a little toppy there as well after a huge run up. These last 2 weeks, speculation they might gain more political support on the fallout between Trump and Musk, but they look to have already made peace. And hence on my watch list for tomorrow, I'm looking at a potential pairs trade, long Rocket Lab, short AST Mobile, using options of course. We've also seen a pullback in some of the smaller AI names like SoundHound AI and Quantum stocks as well, cooling their jets today. And one new stock that recently came onto the market, CoreWeave, it's been an absolute heater, defending this trend line pretty well. I'm keeping an eye on as well. Got some of the most liquid options at the moment, a real hot one amongst traders, along with Palantir as usual, currently sitting at all-time highs, actually still looking pretty good there. And why I've also got it on my watch list optimist as a pair versus core weave. Really juicy options for potential play back to the VWAP, which I may wait for core weave to start breaking down through this uptrend, but I still wouldn't rule out one last final melt up blow off top. It does have that look, along with the trading volume, which you can sometimes see in these IPO stocks. They can come out real hot the first couple of days, they sell off, dip, and they can run up into all that new excitement. Kind of seen this pattern play out time and time again. So it could still have one last final push, but I think it's setting up for a really good opportunity soon, potentially with a bearish play. I can see we're already 43% above the 50-day VWAP. It's quite stretched here. Also still trading really firm cybersecurity stocks, CrowdStrike, along with Palo Alto Networks, still just sitting below all-time highs as well. And some other hot areas of the market, EV toll stocks having a bit of a pullback today, along with crypto, Bitcoin, 106,000. And we actually put on a pairs trade in some crypto stocks today. But a lot of the leaders are still sitting pretty. There's Robinhood, also just below highs. So the market and its leaders still coiling up here, but still not quite there yet on everything. Got the Russell 2000 actually rejecting off its 200-day MA yesterday, and we're getting reversal signals building in all the indices. Actually just got the third one there in the SPY today. So the market could be a little exhausted. Certainly have had a great parabolic bounce for a couple of months now. Things have been very calm, and now we've got a potential catalyst at our doorstep with Iran. Like I said, probably won't boil over, but the chances have certainly risen, as we can see in the price of VIX options, the VVIX. And that's pretty much a wrap for today. Thanks for tuning in to the Daily Market Review. I'm always interested to hear your thoughts in the comments below this video. Otherwise, I'll break it all down for you again going into the weekend tomorrow. Cheers.